There was a graphic that went with that quote, and I put that out on Twitter. It was Exhibit 3. It was the US dollar, year-over-year change. And you guys pointed out that it's at a level that usually leads to financial and economic stress. And there's all these different peaks in that chart over the last few decades, Mike. And on each peak, there is a crisis, as you point out, but it's usually been met with Fed easing. Mike, is it going to be met with Fed easing this time around?
Well, thanks, John. It's always great to be with you. I probably should have used my PR agent. I would say, look, I mean, that chart is provocative. I mean, that's what we do, but it's also informative. And I think there's three takeaways. Number one, the dollar is at a point now where it's causing real stress in the real economy, mostly outside the U.S. That's the way it usually works, right? The transmission mechanism is that, as John Connolly said, former Treasury Secretary back in the 70s, it's our currency, it's your problem. And that's exactly what's happening. EM has been terrible. Some of the other regions have had stress because of the stronger dollar, in addition to higher commodity prices, which is a double whammy. So that's one transmission channel. Number two, once it gets to this level, it doesn't stay there very long. You can see in that chart, it's almost a spike top every time. And then the third point, which is kind of interesting, those spikes are sometimes met with a low in equities, and sometimes met with a high, like that's the beginning of the real decline. Given that we've been declining already this year, it could be a little bit of both. I think we're into the final stages of this bear market. We've talked about this, I think, last week on your show. But that last stage, can be fraught with a lot of risk for investors. And, as you know, John, we're pretty disciplined around our framework, and we just don't see the fat pitch yet, specifically as it relates to S&P 500 equity risk premium. What I mean by that is, while rates have been priced into multiples, what's not been priced into multiples now is the earnings risk, which we're focused on. That can come in two ways. Either the earnings get cut or the equity risk premium blows out and the multiple goes down lower first. Now, as you guys have been saying on the show the last 10 minutes, I've been listening, I think you've got this right in the sense that, whatever rates do in the short term can dictate equity prices in the short term as well. And so if we get a rally in the back end, which looks like it should happen from here, then, stocks could get a little lift here into earnings season. It's kind of the opposite of the June quarter, where stocks sold off into the quarter and then rallied on kind of better than feared news. This time it might be the opposite. We may rally into the earnings season, and then the news is actually worse than feared because companies finally start talking about the risk from currency, the risk next year from a recession, and all those things kind of get priced quickly.